Assalamualaikum warahmatullahi wabarakatuh and very good afternoon everyone. Welcome to EKI 200 lecture for week 9. Today I'm going to discuss a new topic that is business combinations. Yeah. So under this topic, I'm going to explain what is meant by business combination. And since we are using the Australian Accounting Standard, we're going to refer to Australian Accounting Standard Board number 3, ASB number 3, equivalent to IFRS number 3. So we're going to look at what are transactions relate to business combinations, yeah? And I'm going to explain maybe a few key steps in acquisition methods, how we're going to record the acquisitions methods, how to determine the fair value of identifiable net assets, and also the purchase considerations. And from there, you will know that whether you purchase the subsidiary or the company below the fair value or higher than the fair value. So we will determine whether there will be goodwill or bargain purchase from the process. So the nature. I'm going to explain the nature of acquirer and key factors in the identification of the acquirer, identify the acquisition date when actually the acquisition happened. This topic combination will be further explored next semester in AKI 201. In AKI 201, we have few more specific topic on combinations, more advanced topic on this. So I'm going to explain when to recognize and how to measure identifiable asset acquired as well as the liability assumed by the acquirer about the identifiable assets. Okay, we are looking at the value. We have this carrying amount and the fair value. So we are going to record that asset of the acquiree. The acquirer will determine what are the fair value and going to record that asset at the fair value. So this discuss the nature of goodwill, what is meant by goodwill, okay, and how it's measured as well as how to measure gain on bargain purchase. What is meant by gain on bargain purchase? This is where you purchase the subsidiary or another company below the fair value. So that is what I call as gain on bargain purchase. So how we account for gain on bargain purchase? Are we going to put it in our profit and loss, or are we going to put in our reserve? So these are the things that we're going to discuss in this lecture. And finally is about disclosure. Are we going to disclose business combination, yeah, as required by ASB number 3 or IFRS number 3? So as introduction, the IFRS number 3, yeah, provide some guideline to us on how we should account, how we should prepare, how we should determine whether we purchase another company at a lower fair value, a lower price by comparing the fair value of identifiable assets and also the purchase consideration. From that, we will able to determine whether we have goodwill or bargain purchase, gain on bargain purchase. Okay, so specifically business combination occurs when an acquirer obtain control for another business or businesses. This is common situations when you expand your business, yeah, you acquire another company. For example, this is A is your company. A acquire another company B. Maybe you acquire 100%. You bought all the shares. So A acquire or control 100% of B. So B now is known as acquiree, or we call it as subsidiary. This is our subsidiary. Okay. So A now become parents. A become parent. B become subsidiary, or A can acquire another company C, okay, maybe 80%, 80% control, 80% share of C, and now C also known as a subsidiary. Okay, a subsidiary. So this is the process of combination. Overall, can say A, B, and C are in the same group. This is a group, a group. Yeah, a group. I'm talking about the group here. A group. So in a group, we have many companies. We have many companies in a group, and it has one parent company and many subsidiary. So this is talking about, this is what I'm trying to show you about business combination when one company acquire another company. Yeah, so they have control. So A has control on B, control and B, and A can decide what are the strategy that can be applied or be implemented by B. So this is a business combination. So business combination may take various form. So we're going to consider two forms. The first one is an acquisition in which the acquirer purchase asset and possibly assume liability of the acquiree. We take over all assets and liability. Okay. And then subsequently recognize this asset and liability in our accounts. So we purchase assets and also all liabilities. So we're going to record all these asset and liability in our accounts. This is number one. Okay. Number two is acquisition in which the acquirer purchased sufficient share in another entity to obtain control of the entity and hence control the entity asset. So number two is A, acquire the shares, maybe 100% shares, or maybe 70% shares. By controlling the majority of shares, in a simple word, I can say when you have control, for example, when you control more than 50%, so you have control on that company. So indirectly, you control the assets of the company. Number one is by acquiring assets and liability. Number two is by acquiring or controlling sufficient number of shares to establish control. So we need to determine whether a transaction is a business combination or not. For example, assets such as inventory are acquired on regular basis, while plant and equipment is acquired less often. When we acquire asset, yeah, we buy asset from our supplier. That is a common or a regular business activity. So that one cannot be considered as business combination. It's just process of purchasing assets, inventory from the supplier. Same goes to the plant. It's not regular item. You don't buy plant or equipment every week. Maybe you only purchase equipment or plant every year or every 2 years, or maybe not maybe every 5 years. Yeah. So in other circumstances, a group of asset or net asset acquired. For example, you acquire all the asset of a subsidiary of another company. So this might indicate there is a business combination there. So the nature of the asset acquired dictates the accounting standard to be applied in recognizing the transactions. So we have to go back to the accounting standard. So there are two differences between accounting for business combination and accounting for non-business combination. So I'm going to focus on this, accounting for business combinations. In business combination, the asset acquired and liability assumed are measured at fair value, not carrying amount. Whereas for non-business transaction, the asset acquired are measured at cost. Whatever costs you, how much you pay for the asset. So this is the difference between business accounting for business combination and accounting for non-business combination. We're going to look at maybe one example from textbook, and I'm going to do one tutorial question to give you some insight on what it means by business combination accounting, as well as accounting for non-business combinations. So a business combination may arise, to the recognition of goodwill, less commonly a bargain purchase, neither of which are recognized in non-business acquisition. Okay, so the focus of this chapter is where the acquisition of the net asset is deemed to be business combination. I'll give you example what I mean by goodwill. A, okay, purchase another company known as B. Okay, how much A paid B? For example, A paid 120 million, okay, to acquire all shares in B, all shares in B. So as a return, you get 100% shares. Okay. When you check the B accounts, B have assets. Assets. They have the carrying amount as well as the fair value. B also have liability, the carrying amount as well as the fair value. So in the process, you determine that A carrying amount of asset is 140,000. Okay, it's too high there. But the fair value is 160,000. The fair value. Yeah. So in this example, you're going to value the value of B as 160,000. The value of B's asset as 160,000. The liability is maybe 50,000. And the fair value is also 50,000. So what are the fair value of identifiable net asset? Fair value of identifiable net asset. If you use this carrying amount, okay, the value is only 90,000. But if you use the fair value measurement, the value is 110, not thousand, sorry, million. Okay, so the idea of doing accounting for business combination is to determine differences between the fair value of identifiable net assets. So this is the fair value. This is the fair value of identifiable net asset, 110,000. You compare with what cost you the purchase considerations, there is 120,000. You paid 120,000, but you got net asset 110,000. Okay, you paid 120, but you get the fair value of identifiable net asset 110,000. The difference is 10,000. My question is, why you are paying extra 10,000, even though that you know that the value of this asset, identifiable net asset, the land, the building, the vehicles, and minus all the liability is 110,000. Why you have to pay 120,000? You know that value, the value of the assets minus all the liability is only 110,000. You paid extra of 10,000. Sorry, not 10,000. Sorry, I keep talking about thousand. It should be million. Why you waste your money paying extra 10 million when you acquire that assets? Yeah, Mega gave me, maybe because of the company reputations. They have a good brand, they have good reputations. Other than that, maybe you pay for their system, their process. They have a good process. Yeah, they have a good procedure. They have a good location. Yeah, strategic locations. Yeah, near the city, near the main road, for example. Maybe they have their regular customer, loyal, yes, perfect. Loyalty of customer. So when you acquire this business, you don't have to spend a lot on advertising. You don't have to pay the television advertisements. Okay, you don't have to do a lot of promotion because they already have their regular customer. So that is among the reason why you are willing to pay extra of 10 million. So the good location, the reputation, the brand, good process, regular customer, and many, many more reason things are known as intangible assets. intangible asset that we have learned before. So when this intangible asset is acquired or purchased during business combination, so we're going to put in our financial statement this thing known as goodwill. Goodwill. Goodwill is the purchase intangible asset. Yeah, goodwill is the difference between the purchase consideration, the amount paid minus the fair value of identifiable net asset. You willing to pay 10 million extra for all that reasons. There are two key conditions to be satisfied in order for business combination to occur. Number one, the asset or net asset acquired must be a business. You acquire a business, yeah? Or number two, the acquirer must obtain control of the business. Must have control over the business. Okay, so this is the two key condition, yeah, in order to satisfy that transaction fall under business combinations.